Illustrious Intelligent Investment Live crew. I'm Garrett Lill with Matt Dahl of ARPG in Las Vegas. Good to see you, bud, as always. Man, that you weren't lying, man. That is an exceptionally good hair day you're working on right there. I'm not quite so hot, but you are really rocking a strong one today.
Yeah, can we acknowledge it? I mean, really. I mean, I don't know why. I should be on like CNBC with this hair today. I've never. You know what the worst thing is? I'm getting my hair cut today, and every time, without fail, I'm having the best hair day. I get my hair cut, and then I ruin it.
Have you looked into hair modeling?
Well,
there's models for everything.
They
make.
here.
I mean, there are hand models. Surely to goodness, if there are hand models, then there are probably also hair models.
You know, I could fill. I'm sure there's a void for aging, receding, balding hair models.
That's what I'm saying. I mean, there's a demographic for everything. I mean, there's got to be bald models, right? I mean, you've got a demographic.
Bald hair models?
Yeah, you probably have bald hair models because that's kind of that's a little bit self-contradictory. But I mean, there are models for everything. You got hand models, foot models, leg models. There's got to be a way to monetize that mane of yours somehow or another.
I have a, I don't know. I'm just having I'm annoyed that I have to get my hair cut today and ruin this. You know,
it is.
I know I'm not the only one who's suffering. Yeah. You are too.
Yeah.
No one wants to see my hair get cut today.
Yeah. Well, you're not doing much to it, are you? Because I mean, I've known you for 2 years. I have never seen you with a different hairstyle. I don't know how it magically stays the exact same length every single week, but whenever you cut it, I'm sure you've cut it at some point since I've met you, but I've never seen it get shorter. So
this whole thing just comes off, and I set it next to the bed every night. And
you just got a backup hair,
a
backup head of hair that you put back on. Yeah,
that'd be nice.
Man, that would
I need a wig. You know what you do? I need to have this molded so I can have a wig made exactly. So when I actually do go bald, I can just put this on and you'll never know. But is bald a hairstyle? Does bald count as a hairstyle?
Oh, absolutely.
I guess if you have hair to shave it, that's a hairstyle.
That's intentional.
If you're just bald, even though it's the same outcome, it's not a hairstyle.
Most of the time, everybody that I know, well, not everybody that I know, but I know a lot of people that once they even start to get a hint of baldness, they shave it on off. And that way you never know that they were, you don't know if they just chose to do it or if it was, because sometimes some people wait too long to pull that move off, right? Once it starts backing up and then then it's, cat's out of the bag, people knew you were going bald. But if I started to see hair falling out regularly and I could see like a little bald spot on the top of my head that was starting to come through, I could go ahead and shave it. And it's like, yeah, I decided to go with a different look. And you would never know that I was balding if I stayed, shaved for the rest of my life. I know a lot of people that do that. They just can't.
There's no way I would ever shave my head. If this ever came off, my head would look like a russet potato, just weird bumps and knots and stuff.
I can't imagine.
I don't even want to know what's in it. There's probably a small community of little people living in there. I said little people this time.
There you go. That's good. Keep us out of trouble. All right. Well, enough with Matt's hair, I guess. So the inflation report finally came out. The stock market just keeps chugging right along. You can call for a pullback all you want to. You maybe even be right about it being stretched. Does not matter. Market doesn't care. Still just trickling higher and higher and higher. You used a term though in our 35-second pre-production call here that I don't think I've ever heard. You used the term upward capitulation. I'm going to need you to break that one down for me though, because I know capitulation, but that's usually at a bottom. You're saying upward capitulation. What does that mean?
This is a buyer's capitulation, not a seller's capitulation. Okay. Basically, so if you look at the AAII, the investors sentiment index, I want to say we're still pretty low. We're 37% bulls, 42.5% bears, right? So we're still bearish. We're still bearish. So we haven't, but that survey came out yesterday. So it was the survey that took place from this time last week through basically Wednesday, or from Thursday through Wednesday of this week, right? So my guess is that number is going to go up significantly next week. And what we had is we got confirmation of what a lot of us have been believing, that there really isn't we're not seeing inflation. We're seeing Minor inflation, like in sporting goods, I want to say it was 0.7% month over month, which was kind of high. But some of these cheaper, non-consumable products, yeah, those there is inflation in those areas. But remember, shelter is 30 by itself is 30+% of the CPI basket, all by itself. That was only at 0.2% month over month. That's it. That's the lowest number since January of 2021. On top of that, inside of shelter is owner equivalent rent, which is if you're renting or you're renting your house out, that's another big component of that. And that has been just off the charts. If you remember back 18 months ago, 24 months ago, owner equivalent rent was all the rage. I mean, rents were going up 1% a month, and you wanted to rent an apartment that last year was $1,200. This year is $1,600 a month. Okay, all of those have absolutely collapsed. We have owner equivalent rent came in at 0.1%. That's the lowest number since November of 2020. So there is not a lot of, there really isn't any inflation or what we would call outsized inflation to speak of. We're not seeing a tariff-driven inflation because tariffs cannot cause inflation because it doesn't change the supply-demand balance. It simply moves prices up. So what happens is if things become more expensive or there's less money, there needs to be some sort of accommodation on the fiscal side. So we've not seen anything in the area of inflation, but we have seen is a significant cooling of labor. Okay. Again, the first 4 months of the year, we had 147,000 average jobs per month. The last 4 months, since they were able to measure since before the government shutdown, is 27,000 a month. Okay. So it's a massive difference we've seen. So, and now we have this government shutdown to contend with. Okay. Now we've got basically 160 million working people in the United States. Federal workers are somewhere, I mean, people that have shut down is about 800,000 or 900,000. So it's a small percentage. It doesn't matter. But the narrative that surrounds it is pretty powerful. Okay. So now it just adds to that big labor problem that we're kind of facing. And again, these aren't jobs, these aren't cashiers at a convenience store that make $8 an hour. These are federal workers. These are lifetime employees who make good money with great benefits, who have pensions, who've got plans, who have discretionary income. It's those people now that are not being paid. So that adds to that narrative. So when I went to the CME this morning and looked at rate cut projections and for October 29th and December 10th, we are at we're 98% chance of a cut on next week on the 29th. And we're at a 96% chance of a cut on December 10th on top of that. So there's a 96% chance we're going to be an upper bound of 375 on the treasuries end of this year, which sort of matches where we think the 10-year is going to be. I might add that the upper bound on the treasury right now is 425. It's sitting at about 408 right now, 410. Okay. And the 10 years at 4. So I think we're going to land very close to that 375 number end of this year. And I think that is I think that's going to be sort of that extra sauce that brings that market up into that 7,000, maybe 7,200 range. I mean, I might have missed this a little bit on the downside. I know that sounds crazy to think that I would miss it on the downside, thinking that because I was like, this thing could get to 7,000 by the end of the year. When we said that, it was May and things were not doing so well. Well, the market has a way of humbling you really, really quickly. Yeah. So could be.
Yeah, and did you get into the momentum index that you were referring to there? How is that momentum index calculated? What is it? What does the momentum index mean to the market, and how is it used as an indicator?
So it's the Goldman Sachs momentum index, and the calculation is basically the high momentum basket of companies against the lower momentum, and it's a division against the lower momentum, the market itself. And what we've seen is the market basically, we've seen that momentum basket come down 15% against its counterparts in over the course of 10 days. Fundstrat had a great take on this, Tom Lee did, and he talked about how when that takes place, that's a capitulatory event. Okay. And he sees this, and there's a 97% chance that 6 months out, there's going to be about a 15% gain in the market, which I agree with. I think the next 3 months are going to be good. However, I think we might run into this little sort of donut hole into the middle to the end of November, maybe into early December, and it could come from anywhere. Okay. That just gives us a little bit of a buying opportunity. I don't think there's anything inherently wrong with the market. There's nothing structurally wrong with the economy. None of those things, with the exception of the labor issue that might be kind of rearing its head, but now the Fed is fighting that with lower rates. But we've seen, we've seen the earnings revisions up. We're seeing $345 a share for 2027. But we also have to contend with the market is priced for absolute 100% perfection right here, right now. If one thing goes wrong, it could pull this thing back 2 or 3 multiple points like that. And we're sitting at 22.82 times earning as we sit here right now. Tech is sitting at 30.5 times earnings. Now tech is growing by 20% a year, 21% a year, so there's no issues there. The market's growing by 13, 14% a year. And frankly, we're probably going to see a pretty strong earnings growth this year, which will bring us a 14% earnings growth this year. I mean, even consumer discretionary is sitting at 30 times earnings. Industrials are sitting at 24.5 times earnings. Okay. This to me is early cycle. This is an early cycle momentum to me, but the market is just a little outside of where I think it should be in a general longer term trend channel. Okay. I know that's a technical thing. And I'm certainly no amazing technician, but the earnings are good and growing and strong. The economy is good and growing and strong. I think we're probably going to come in this year around 2% GDP growth. Next year, probably around 2.2. I know the Fed says 1.6 and 1.8, but I think they're wrong. Okay. This feels early cycle to me. So I think, we've got an Apple iPhone super cycle that's doing tremendously well. I think Trump's meeting with Xi next week or the week after, that's now back on, I think is very positive for Apple and very positive for the entire tech sector, which is 30% of the S&P 500. So there's a lot of market tailwinds that are taking place right now. But you have to contend with, we're at almost 23 times earnings. If something goes sideways in the meeting with Xi, again, what I've been surprised with is the resiliency of this market. And today is no different. Through government shutdowns, through the issues with the private credit collapsing, not private credit, but there are some private credit issues that took place with some of these regional banks that were lending to private lenders. Okay. And some of those collapsed. Those were very quick 1 to 2 day pullbacks and they were bought. Today, we had President Trump say, trade negotiations are off with China. Market went up. Okay. Again, back to government, everything else, nothing is shaking this market. I feel like there's only 2 things that can really shake this market right now. And that's interest rates through inflation or something happening with China. Okay. Those 2 things what seem to be driving the market's concerned with those 2 things. And because we had a very tame inflation report today, and it wasn't just tame, it was incredibly, just the ingredients of it were great. I mean, we had shelter low, we had owner equivalents rents low, we had used cars collapse to negative 1.6%. So we had a lot of those positions, the internal components of inflation, which would point to a longer term, more durable disinflation or lower inflation regime that took place today, which means we're going to have rate cuts. So, but it's like a really good cheesecake. It's great, but too much of it's not great, right? Yeah. So, okay, we keep getting these low inflation numbers and these weak labor numbers. Okay, so we're gonna have a cut on October 29th. We're gonna have a cut on December 10th, and the cut on January 28th. Okay, it's even money right now. It's exactly even money, 50-50, whether or not we're gonna have another cut on January 20th, bringing that upper bound to 350. Okay, when you get into where we're continuing to cut, I think we're going to have 3 rate cuts next year, but I would like to see that cutting cycle slow a little bit. Let everything catch up, because if the market thinks that the Fed is trying to get ahead of a potential labor recession, the market will sniff that out, and that could pull us back pretty hard for a little bit longer period of time. So right now we're sort of in a good inflation number is good news. Bad labor number is bad news, but not terrible news. But as you lower interest rates, as the Fed lowers its policy rate, each successive cut, it has less meaning, right? Has less impact. So now all of a sudden we're cutting rates because we think there's a problem, not because we're trying to remove restriction, but we're trying to add accommodation, and that could be a bit of a digestion period.
Yeah. You know, this is, I know you're not a golfer, but when you talk about this is how we do things on the show. Like we talk about the stock market. I use golf to create analogies, and you use race cars to create analogies. Race cars probably make more sense because I know, I don't race cars, but I do follow racing. So I know that lingo a little bit, but I just don't have a racing analogy for this. So we're gonna have to stick with golf. But you talk about the market price for perfection, right? It doesn't mean necessarily that it's overpriced, it's got to go down. But a lesson that I've learned, 30 years after, into playing the game of golf is that just because you can, in say optimum conditions, hit a certain club 150 yards, doesn't mean you should hit it when it's 149 yards over the water, right? Like you have to give yourself some margin of error. Yes, I can, in perfect conditions, 1 out of 10 times, hit it over the water with this club. But maybe I should take a little bit extra club so that I don't have to hit it perfect to keep my ball dry. That's a lesson that I've learned. I've actually just applied this a while back. I was playing a little tournament thing, and it was that situation. I had the club that I needed to hit perfect, and I very intelligently put it away, grabbed the next one, mishit it a little bit, hit it to 5 feet. So sometimes you got to give yourself a little bit of room to be wrong because you're not perfect usually. That's why it's called perfect, right? That's you may be priced for perfection, but you don't hit perfect very often. So you got to give yourself some wiggle room.
Yeah.
Is there a way to make that a racing analogy? Can we do that?
100%. I was just getting ready to do that.
All right. I want to hear it.
So let's say the air is really good, the track is really good. You're like, okay, I think I want to rotate the earth. I want to lay a number down. I want to throw the wood to this thing.
There you go.
So we put timing in it. We put fuel in it. We jack up the launch RPM. We do all those things to make this thing just take off and rip. Okay. So there's no issues. We think, okay, we're going to go up and do this. Well, I don't know, about 20 minutes before it's our turn to run, somebody somewhere throws a rod out the side of the motor, oils the entire track down, and now there's a 2.5, 3 hour cleanup process. Well, now instead of running at 10:30 in the morning when it's 68 degrees out, now it's 1:30 in the afternoon. The track is heated up and it's 85 degrees, and that track is not what it was 3 hours ago.
Yeah.
Okay. But you got that same tune-up in there.
Yeah.
And then you go out there, you spin the tires, and you lose the run. It doesn't go anywhere. Okay.
Yeah.
Because something happened that was completely out of your control that you didn't see coming, that caused a delay, that caused what you had baked in as a tune-up to be far too much for what that track could hold. It was perfect for when the track was at 71 degrees or 60 degrees, 68 degrees, but didn't work when it was 90 degrees. Yeah. So what the market is doing right now is the market is the tune-up is set for a perfect day, a perfect track, lots of tractions, no problem. But if somebody goes a track down, or the sun comes out, or anything happens, there's going to be a pullback. And it's not going to be a fundamental pullback. It's not going to be, oh my God, earnings are going to go from $345 a share in 2027 to $300 a share in 2027. It's going to be a multiple contraction of probably 2 to 3 multiple points. So call it from 23 down to 20, which would take it, down about 900 points, somewhere in that range. Somewhere between 750 and 900 S&P points, which would take it right down in the $6,000 range, or in the 6,000 range, right? So but then of course, then you have people like me and the other buyers like, well, we're kind of waiting for a pullback because we believe in the market, we believe in this long-term bullish cycle. So we don't think there's anything fundamentally structurally wrong at all. It's just a little overpriced. So we're waiting for the market's DeLorean to show up and take us back in time. We need Michael J. Fox and Christopher Lloyd to kind of send us back to sometime in July, right? Yeah. So that we can do that. But here's the thing is, I'm not the only one waiting for this. There's a lot of other people that are buying, and they bought that quick dip last week with the private credit. When we had that little sort of smoldering amber, it wasn't even a smoldering amber. It was like an ashtray from the 70s. They was smoking a little bit. That's all that was. And then it immediately got bought. So and that just goes to show you how confident this market is.
Well, and I can give you an interesting. I've done just about I have dabbled in almost every practice in the markets in some way, shape, or form. Never successfully, but that's why now I just do shows. But I did a little run there where I was like day trading options. Highly do not recommend that for you folks out there. Please do not take this. And of all the things that I could ever say, we're here for entertainment and education purposes only. This would be the epitome of that. But I would follow these like 200-day or 200-minute crossover strategies. Like the market moves above this, you buy. The funny thing was, if you put in like a market order, as soon as I was buying, so was everybody else, and my market order would always get filled for like 5% higher than what I was expecting the price to be. Because yes, I'm buying, but so is everybody else. There were a lot of other people waiting for that very same thing. That's a momentum type of a trading strategy. But you flip that upside down, value side's the exact same way. If you're trying to buy based on price, when the market gets to 61, 62, some people are going to go ahead and say, I'm not going to take the chance on it falling another 100 points. I'm going to go ahead and buy it. Well, guess what that does? That stops the decline. So you end up kind of setting these price ranges, right? Of, okay, we're at 68 right now. At some level, I'm going to start buying, but you're not always going to be lucky enough to time it and put your buy in and be the absolute first one to buy, right? Usually there's going to be others at the feeding trough there with you, looking to get in the game at the same time. So what is your range right now that you're kind of watching for that, okay, when we get to here, this is where I'm starting to get aggressive, or starting to want to dial up the aggressive is probably not the right word, but at what range are you starting to say, okay, now it's time to get our feet in the pool?
I would say 20,000 NASDAQ, sub 6,300 on the S&P. We're not talking, here's the thing, is that's not a timing thing.
Right.
Like you said, if you're trying to time the market and be the first one to buy, you absolutely are not going to be that person. Yeah. And you're not going to be good at timing the market. So when the market pulls back, and it will pull back, it always does. When we get into maybe gets to 62.75 or something, and I pull the trigger there, maybe the market's in 19.8 on the NASDAQ and I pull the trigger there. Okay. There is no chance on God's green earth that I'm going to buy the bottom. Right. Okay, I'm not going to be the first buyer. That's not going to happen. The market will very likely go down from there. Period. It just will, because I'm not trying to time it. I'm trying to say, okay, now at 6,300 on the S&P, based on $310 a share for 2026, that feels like a good enough value to me. Yeah. Okay, I can make sense of that. Okay, but if it goes from 63 to 57. That happens, and that's okay. That's what value investing does. Okay, market timing does well. I think the market it has support here, so I'm going to buy it here. I'm going to wait till it gets to this point, and then so it gets 2/3 of the way, but you never buy it because you're trying to buy the bottom, and then it stops, turns around, and goes the other way, and you miss it. Okay, and then you end up buying it much too. It's like the guy who said, well, I'm going to wait for housing prices. The house was $300,000. So I'm going to wait for housing prices to come down. Next year, the house was $350,000. I'm going to wait for housing prices to come down. Next year, the house is $400,000. I'm going to wait for housing prices to come down. Next year, the house is $450,000. I'm going to wait for housing prices to come down. Next year, the house is $500,000. I'm going to wait for housing prices to come down. You have that is down to $475,000. Ha. See, look at the deal I got.
Well played, sir. Well played.
Like that's what market timing will get you. So you have to look at value in earnings and have a true understanding of fundamentals, but also understand market inefficiencies. Because market inefficiencies, I know that sounds egregious to a lot of people. Their market is 100% efficient 100% of the time. No, it's not. Okay, it can be inefficient on the downside, like we saw in April. It can be also inefficient on the upside, which what I believe we're seeing now. Okay, and when it gets inefficient like that and it gets dislocated on either side, that's where opportunity comes in. Because sometimes you make money when you buy it outside when it's dislocated to the downside, so you're getting a deal. Sometimes you're making money when you're not participating on the upside and you're you're then effectively putting almost like a soft put on it, right?
Yeah.
You're not buying the put, but you have reason to believe the market will come back down to some level of reasonable valuation, and you can purchase it there. Because the one thing I have to be careful how I say this, but if the market goes to 6,900 or whatever, and then say, okay, well, and the market pulls down to 6,300, well, then we've sort of seen the future. 6,300 when it first gets there in July is not 6,300 if it gets there in January when it was already at 7,000. Those are two very different 6,300s. Okay, one is a value, one is not. Okay, so.
Well, and I think it's important to just interject here, and for viewers or listeners that see every single show, they would know this, but on the off chance that you might have missed the episode that Matt said this, we're not saying that Matt's sitting here 100% cash right now against the market, right? You're just talking about putting new money to work, right? You're still very invested in the market. You're just saying that and I love the way you've worded it before. It's not timing the market, it's pricing the market. You think a good value for this market right now is roughly 6,300. You don't think 6,800 is a price you want to pay for it. Okay, fine. At this point in time, that's the price that you want to pay. There might be another point in time, a year from now, where we're talking about this and you would love to buy the market at 6,800, right? And just like you're saying 63 now from back in July. So, but that doesn't mean that you're, one of the biggest problems investors can create for themselves is to go all or nothing, one or the other, green, red with no yellow in between, right? You've got to, we're talking small changes here. You're not shorting the market or cash. You're just not putting that new money to work. And oh my gosh, what's the worst thing that happens? We never see 6,300. Okay, we just keep rallying. Well, that's fine. You've still got plenty of money in the market. It doesn't mean that you're all in on this side. It just means that for new money, you're waiting for a different price. And if you never get it, then you'll put it to work later. It's fine. It's not, you're not all in on one side of the table.
Well, here's the thing. When you're sitting at 23 times earnings, you're in the 99th and a half decile of market valuations. The odds are really in your favor that at some point there will be any kind of a pullback. But yeah, we are fully invested with our clients' money. I stopped allocating new dollars at 21,000 on the NASDAQ. Okay. Yeah. That's kind of when I stopped allocating new dollars, and I use different instruments to get a return, but nothing correlated to the market until I see some better value structure. Although earnings estimates are going up and interest rates are coming down, a lot of that is priced in. So I think the market right now is priced for the end of probably the middle of 2027. I would like to have the market at least price itself to the more like the end of 2026.
Well, and here's the thing too. You use the guy buying a house at 475 instead of 500. I mean, I could listen to our conversation as a fly on the wall and say, it kind of sounds like Matt could be that guy, right? If he just sits here and waits, and then he gets a pullback from, I'm not going to buy it at 6,800. And then you get a pullback from 75 and you buy it at 69 and they're saying, well, that was stupid. It's not the same thing though. You're right. 6,800 now is not the same thing as 6,800 in 6 months from now. 6,300 now is not the same as what it was 6 months ago, because at that time you probably wouldn't be buying at the 99.9 percentile or 99.5, whatever, in terms of valuation. So even though you could end up, let's call it what, there is a possibility you don't get your pullback, right? Let's just acknowledge that for the show, that there is a possibility you never get your pullback, right? You may end up putting that new money to work at 7,000, but you would be doing it presumably, I guess, at better probabilities for success at that time.
Right. Valuation as a market timing tool is maybe the worst version of that, right? But again,
what's the quote? The market can stay irrational longer than you can stay solvent. Yep. I love that one. Yeah, that's a great point.
And it's true. So it's one of those things where you want to make sure clients are participating in the market, in something, so their money is growing alongside of the market. And if the market comes back and there's an inflection, which, and listen, people like me, and there's a lot of, good advisors, and there's a lot of good money managers out there. We understand one fundamental core concept. we don't live in a world of certainties. We live in a world of probabilities. And the higher the probability, the more conviction you can put to your decisions. Okay. Now, what we have right now, what I believe is a very, very, very high probability that we will revisit 21,000 on the NASDAQ in, within the next, 60 days or so. Okay. Being that we have that high probability, in my opinion, leads me to have high conviction for that decision. So, it was funny. I was at a birthday party for a friend and his son, actually, on Sunday night, this last Sunday night. And I was sitting at the dinner table, and this woman across, she asked what I did, and I told her what I did. She goes, "So is it true that the whole banking system and the whole market, everything is going to collapse like in the next 30 days?" Like, what? Say it again? She said, "Yeah, the whole, all banking and all the money and everything's going to be gone, and the whole market's going to collapse. Everything's going to collapse before the end of the year, the next 30 days or something." And I was like, "Did you watch a movie?" No. I said, earnings are really good. Interest rates are coming down. She goes, "What about the banks that are failing right now?" I said, "Banks didn't fail." I said, "Banks wrote off some bad loans because of from what I was able to read through the news, that the people that were lent, that they were having the money lent to, who were also lending the money out, weren't forthright and honest about how they were using those dollars." Okay. And there's an issue there. So, but the banking system is sound. Banks are very well capitalized. Earnings are very, very strong. And again, back to financials being at 16 times earnings, industrials being at 24.5 times earnings, market growing at 13.5, 14%, NASDAQ growing at 22 and 19 for 2026 and 2027 respectively. An administration that's very pro-business and low regulatory environment. It's coming down the pike. I think we're going to have. I think this is great long term. I think next year is going to be. I think tax season next year is going to be really, really good for retailers. Actually, I think there's going to be a lot of. I think there's going to be a lot of return. I think there's going to be a lot of tax returns.
Yeah. Well, and I think it's interesting to point out here as we close it up that you. And I like to spotlight you on this because I do think it should, people who are watching should tell their friends. Matt does have a really good track record, and when he says these things, they do play out pretty well. And we've got receipts for that. If anyone wants to go back and see some of the past shows, you can go back and see where he's done this. But that being said, Matt's a professional. One of the reasons that you're good at what you do is because you also know how good you're not, right? You're not going to hit it perfect every single time, and you know that. So even though you do have a good track record, you're still, again, playing probabilities, not certainties. So
sure, but you know what they say: yesterday's home run doesn't win today's game.
That's right. Yeah, exactly. So, and I think that's an important thing to. So the professionals who know have a pretty good idea of what they're doing, don't push all their chips in on any hand ever, really. And a lot of investors who don't know nearly as much are a lot quicker to take the big swings. So just a good little food for thought as we wrap up there is that it's discipline is a virtue. I think that would be an agreeable way to say it. So as always, though, we're here for entertainment, education purposes only. Everything that we say is our opinions, and don't take it as the gospel. Talk to your own financial advisors. And if you don't have one, talk to Matt. You can reach him at 702-655-8300 or someone on the best team in the world. Even if someone else thinks they have the best, they have the second best. Is that the way you said it last time?
Right. There's a lot of really good second place people out there.
That's right. But as far as teams go, he has the best, hands down, in not just this industry, any industry in the history of ever, right?
I have the best team ever assembled for everything ever.
Yeah. Awesome. Good to see you, man, as always. See you next week. Hope you have a great weekend, dude.
See you.
Later.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.